We're going to talk about something that if you're in the housing market is going to be a really, really big deal and could save you a lot of money. But we definitely have to weigh the pros versus the cons. Now, what are interest rates on homes right now? 8%, 9%? I mean, it's getting real crazy and ridiculous, and it's really causing people to have a lot of hesitancy before entering into the market, because the higher the interest rates, the less house you can afford. Hey, a $300,000 house at a 3% rate is way cheaper monthly than a $300,000 house at an 8% rate. But there is a way where buyers in this market can get interest rates as low as 2.25, 2.8, 3.5%, and I'm going to tell you how. If you're new to the channel, first hit that subscribe button and hit the bell notification so you can get updated on new videos. I'm Marcus. You're at the channel The Debt Free Dad, where we're talking financial takes, topics, and attorney reactions. This is an old school throwback explainer video. Back in the day, I used to have the whiteboard and the standing up, and it was more grainy than it is now. But I'm gonna sit down for this one. Assumable mortgage. Well, DFD, what is an assumable mortgage? Think about it. Most times when you go to buy a home, you have to go to a lender, you find the best rate that you qualify for, then you go on your home search. Well, there is a concept called an assumable mortgage that allows you, the buyer, to assume the loan terms and obligations of the seller. So if the seller had a 3% rate locked in, the current market is 8% locked in. If you qualify for an assumable mortgage, you can assume that 3% rate and save you a lot of money. Now, before we go in, there are some things that we got to discuss. It only applies to certain type of loans. So if it's a conventional loan, it's probably not going to apply. FHA loan, definitely going to apply. VA loan, definitely going to apply. USDA loan is definitely going to apply. Now, have I ever used this? No. You know, DFD is transparent. I've never used it, but I do have friends, colleagues, persons who are in the real estate game who have used this during this current time. In order to have an assumable mortgage, first things first, what do you think it is? You have to qualify. You have to qualify to actually be eligible for an assumable mortgage. If it's an FHA loan, the Department of Housing, the federal government has rules that assumption has to be done within 45 days. Now, VA loans, they take a little bit longer. So if you're a well-qualified buyer, I'm talking about, 720, 730s or up, chances are you'll likely qualify for assumable mortgage. What does that mean, and what are some of the pros? Well, for the buyer, one, it gives you a lower rate. Because you have a lower rate, it may put you in a position, or will put you in a position, to save a lot of money. The other thing is you don't have to shop around. You don't have to go from financer to financer to look and see what different rates there are, because you're assuming the rate that the current buyer already has. Now, for the seller, one of the benefits is, because they're assuming a lower rate, you could potentially charge more for your home because they can afford more, because they're getting a 2.8% interest rate instead of an 8% interest rate. You can agree to selling terms to sell a little bit higher than you normally would, because the buyer is essentially saving a lot of money. The other thing that could happen to the seller that you have to be cautious for, seller, you are responsible for those mortgage payments until this is final. So during that time of processing, as those mortgage payments come due, you have to make the payment. So essentially what will happen is you'll have a firm sale price that's established, then you'll have a floating sale price. That floating sale price is generally what the sale price is going to be as time goes on, mortgage payments are made. The person who's currently in the home, the seller, is making those payments so that you can adjust everything when things are finalized. Now, most times when you go on Zillow or Redfin and look for assumable mortgages, you're probably going to find like 3 listings, because one, people don't generally list their properties as assumable mortgages, so you're not going to find a lot online. And sometimes, and one of my good real estate friends have told me this just recently, that sometimes, companies are like, no, mortgage servicers are like, you can't do this, you can't do this. Unbeknownst to them, because it's not done often, mortgage servicers have an obligation. If you qualify, they can't necessarily deny you the assumable mortgage. So, hey, it works out in your favor. One of the things you have to note, if you are a veteran, DFD is a veteran, I have a VA loan on my home. Typically how VA loans work, hey, the VA will guarantee a loan for you up to a certain amount, and once that home is paid off, I get that benefit back to use it on another property. So that's typically, you don't pay PMI, but that's typically how VA loans works. VA loans has a specific nuance when it comes to assuming a mortgage, because I lose my benefit because the benefit stays with that property. So in my example, if I were to, hey, a buyer came up with a great price, they wanted to get in on this 2.2% interest rate that DFD have instead of paying 8%. If they qualify, they're a well-qualified buyer, they qualify to assume my mortgage. When they assume my mortgage, they'll have to take the remaining balance. They're obligated for the remaining payments. When I go to purchase a new home, I can't use my VA benefit. My VA benefit stays on this property until it is paid off. Once it's paid off, then that VA benefit, hey, comes back into my power and I can use it on another property. So that's one thing you have to think. Now, let's break down the math. And I think the best situation where you can use an assumable mortgage is when you are in a home and you're looking to sell that home and move into another home. And let me explain why. Okay, let's give an example. House A is $300,000. You have the buyer who wants to come up and buy this home with this assumable mortgage concept so he can get a low 3% interest rate instead of paying 8%. Well, this is how it works. The house is selling for $300,000, but what if the owner of that home only owes $200,000 on that property? Now the buyer's in a unique situation, because if he assumes the mortgage, the buyer only assumes that $200,000. He has to come up with the $100,000 difference to satisfy the purchase price. Now, there are a couple ways you can do it. A, the buyer can just be a baller and have that money cash to pay it outright. That's number one. The most common way people normally get some type of alternate financing. Hey, they'll assume the mortgage for the $200,000. They'll get a loan from a financial institution to satisfy the $100,000. And overall, the math tends to work out where the rate is lower. But the reason I say I think that this is best used when you're in a home and you're selling it to move to another home, because most times, not all the time, but most times, if you sell your home that you're in and you're not underwater, you have some profit. When you have some profit there, that puts you in a great position to pay anything that's over the mortgage obligation on that property that you want to purchase. So in that same example, if I was in a house and I sold my house and I made $150,000 profit, it will work out perfectly, because I can assume the $200,000 mortgage obligation for the 3% instead of 8%. The $100,000 in equity that I need to pay the seller, I can pay that out in cash. And now I'm only locked in at that 3% rate. It could get a little messy when you're buying a home using an assumable mortgage type of concept, and you have to get alternate financing. And the reason it could get messy is because, think about it, this person could have assumed the mortgage payment of 3% at $200,000 that was the remaining balance owed on it. If they got alternate financing for $100,000 so that they can buy the house completely, because you got to pay the seller his equity that he wants, nobody's going to give you a deal on a house like that. But if that buyer goes to the bank to get the loan for the $100,000, that interest rate is probably going to be a lot higher than the 3% from the mortgage that he assumed. So it could tend to make things a little bit complicated. So normally when you see an assumable mortgage being used, it's used when a person is in a residence, they have equity, they sell it, they have some windfall that's probably tax-free because they sold their primary residence. Now they're moving into a new property. They assume that mortgage and get a lower rate because it's a lot cheaper to do that as opposed to going to a lender and getting an 8% rate in this current market. anything that's the difference, they use their cash, their windfall from the sale of their property to satisfy, and now they're locked in at that low interest rate. It's a great concept. If you're buying a home in this market, it's something that you definitely should talk to your realtor about, because hey, the difference between 8% and 2%, we're talking probably, depending on how much the house costs, thousands of dollars a month. Like, yo, I had my interest rate drop from 4 to 2.2%, and it saved me like $1,200 a month. So, hey, it's a big difference. I hope y'all found some value from this video, and if you enjoyed this video, make sure you check out the video on the screen. There's going to be more content related to finances and attorney reactions.